On the morning of Friday, March 26, 2021, the phones started ringing on trading desks all over Wall Street. Goldman Sachs was quietly offering enormous blocks of stock for sale, billions of dollars worth of Viacom CBS, Discovery, and a handful of Chinese technology companies. Then Morgan Stanley started doing the same thing. By the end of the day, close to $20 billion in shares had been dumped onto the market, and the biggest investors in the world were all asking the same question: who is selling? Because whoever it was had to be enormous, bigger than most hedge funds anyone could name. And yet nobody, not the traders, not the journalists, not the analysts glued to their screens, could put a face to the selling. The man behind it controlled one of the largest fortunes on the planet. He had no website, no public investors, and had given almost no interviews in his life. He drove a Hyundai SUV to work and lived in a modest suburban house in New Jersey. The richest man you have never heard of. By Monday, his entire fortune was gone. His name is Bill Hwang, and what happened to him that week is, by most accounts, the fastest destruction of a personal fortune in modern financial history. Roughly $20 billion, wiped out in about 2 days. Not stolen, not hidden away on some island. Simply erased. Because the whole tower had been built on a kind of leverage so extreme and so invisible that the banks lending him the money didn't even know about each other. And when the tower came down, it didn't just crush him, it blew a hole of more than $10 billion through some of the biggest banks in the world and helped push one of them, a 167-year-old Swiss institution, toward its grave. This is the story of the invisible billionaire. How he built a secret fortune bigger than most famous hedge funds, how the machine actually worked, and the 48 hours in March when the whole thing turned to zero. Bill Hwang was not born into any of this. He was born Sung Kuk Hwang in South Korea in 1964, the son of a pastor. The family had little money, and when Bill moved to the United States as a young man, he barely spoke English. He worked his way through the University of California in Los Angeles, earned a business degree at Carnegie Mellon, and took a job as a stock salesman at Hyundai Securities in New York. It was there, in the early 90s, that he caught the attention of one particular client. And this client happened to be one of the most legendary investors alive. Julian Robertson, the founder of Tiger Management, ran one of the most successful hedge funds on earth, and the young analysts he trained were known across Wall Street as the Tiger Cubs. Robertson liked the quiet Korean salesman who seemed to know Asian markets better than anyone in the room. He hired him. Understand what that meant in the world of the 90s. Tiger Management was one of the 2 or 3 most famous hedge funds on earth, and a seat inside it was the closest thing finance had to a knighthood. The traders Robertson trained went on to run some of the biggest funds of the next 30 years, and the industry gave them a collective name, the Tiger Cubs. Bill Hwang, the pastor's son who had arrived barely speaking English, was now one of them. And in 2001, Robertson staked him with his own money to launch a fund of his own, Tiger Asia. Tiger Asia was a hit. Through the 2000s, Bill Hwang built it into one of the largest funds investing in Asian markets, at its peak managing billions of dollars and posting the kind of returns that make a manager famous inside the industry while staying unknown outside it. That combination, brilliant and invisible, would define his entire career. But in 2012, the first version of Bill Hwang's empire died. American regulators accused Tiger Asia of trading Chinese bank stocks on inside information. The firm pleaded guilty to a fraud charge, paid a settlement of $44 million, and Hong Kong banned Hwang from trading in its markets for 4 years. Goldman Sachs and other banks put him on their internal blacklists, too risky to do business with. His fund was finished. Most careers do not survive a guilty plea. His was just getting started. Because in 2013, Bill Hwang did something quietly brilliant. He took the roughly $200 million he had left, gave back all outside money, and reopened as something called a family office, a private firm that manages only its founders' own wealth. He named it Archegos, an ancient Greek word from the Bible that means the one who leads the way. And here is the detail that makes everything that follows possible. In the American financial system, a family office is subject to almost none of the rules that hedge funds live under. No registration of its holdings, no public filings of what it owns, no disclosure of how much it has borrowed. Think of it as the difference between a bank vault with inspectors walking in every quarter and a private safe in a basement that no inspector will ever see. For 8 years, inside that private safe, Bill Hwang performed one of the greatest and least witnessed runs in the history of investing. He turned $200 million into more than $20 billion. Sit with that number for a moment. It is a 100-fold return. It means that by early 2021, this one unregistered family office in New Jersey controlled more wealth than the famous hedge funds that get written about every week. More than most people will ever associate with a name they have never once read in a headline. If he had been a fund, he would have ranked among the giants of the industry. But he wasn't a fund. Legally speaking, he was just a very rich private citizen managing his own savings. And the American rulebook had almost nothing to say about him. And while the fortune exploded, the man did not change. He kept the New Jersey house. He kept the Hyundai. He gave hundreds of millions of dollars to his Christian foundation, Grace and Mercy, and started his mornings before dawn listening to recordings of scripture. Colleagues describe a man with no yachts, no parties, no scandals in his personal life. A billionaire whose one addiction was the market itself. Even the banks came crawling back. The same institutions that had blacklisted him after the guilty plea looked at the fees a client this size could generate. And one by one, Goldman Sachs included, they took him off the blacklist and started lending. Keep that in mind as this story unfolds. Everyone who got close to Bill Hwang decided the money mattered more than the history. So how does a man quietly turn 200 million into 20 billion without anyone noticing? The answer is a financial instrument with a boring name and explosive contents, the total return swap. It works like this. Instead of buying a stock yourself, you pay a bank a fee, and the bank buys the stock for you. On paper, the bank owns the shares, but every dollar the stock gains or loses lands in your account, not theirs. Think of it as betting through someone else's hands at a casino. The chips are on the table, the bets are enormous, but when the room looks around, all they see is the bank. Your name appears nowhere. Now add the second ingredient. Borrowed money. For every dollar of his own, the banks let Hwang bet $5 or more. And now the third ingredient, the one that turned this from aggressive into catastrophic. He did this with 8 or 9 banks at the same time. Goldman Sachs, Morgan Stanley, Credit Suisse, Nomura, UBS, Deutsche Bank, Wells Fargo, and more. And because family offices disclosed nothing, no single bank could see what the others had lent him. Each one thought it was dealing with a big, concentrated, but manageable client. Stacked together, prosecutors would later calculate $36 billion of family money was controlling positions with a total exposure of around $160 billion. One man, invisible, holding one of the largest stock portfolios in America, and the portfolio itself was the opposite of careful. Hwang did not spread his bets across hundreds of companies. He hammered them into a handful of names he believed in with religious conviction. The Media Group, Viacom CBS, Discovery, and a cluster of Chinese technology stocks. The positions grew so large that they bent reality around them. When Archegos bought, the stocks rose, which let him borrow more, which let him buy more, which pushed the stocks higher still. Through late 2020 and early 2021, Viacom CBS roughly tripled. Analysts scratched their heads looking for a reason. The reason was sitting in a home office in New Jersey. By March 2021, by some estimates, the economic exposure Hwang controlled in certain companies amounted to more than half of all their freely tradable shares. He wasn't just betting on these stocks anymore. He effectively was the market in them. If you want to see how detached from reality this machine had become, look at one stock in particular, a Chinese online education company called GSX Tech to Do. Through 2020, some of the most respected short sellers in America published detailed reports accusing the company of massively inflating its user numbers. One famous investigator called it a near-total fraud, in public, with evidence attached. In a normal market, a stock accused of that collapses. GSX went up. It doubled and kept climbing, defying every report, because on the other side of those short sellers stood an invisible buyer with functionally unlimited borrowed money, hoovering up everything they sold. Professional investors were left staring at their screens, wondering what force of nature was propping up a stock the whole street believed was rotten. The force of nature was one man's conviction, multiplied by 5 banks' leverage. A machine like that has one fatal property. It works beautifully, right up until the first day it has to run in reverse. That day arrived on Monday, March 22nd, 2021, and the pin that popped the bubble came from the most ironic direction possible. Viacom CBS, the stock Hwang had pushed to record heights, looked at its own share price and decided to take advantage of it. The company announced it would sell $3 billion of new shares at these wonderful prices. It was, on paper, a perfectly sensible move. But the announcement told the market something simple. Even the company thinks its own stock is expensive. The next day, the stock fell hard. The day after that, it fell harder, down more than 20% in a single session. And inside 8 separate banks, 8 separate risk computers all lit up with the same message at the same time. The giant client needs to post more money. This is the mechanism called a margin call, and with leverage of 5 to 1, the math is merciless. When you control $5 of stock with $1 of your own, a 20% drop doesn't cost you 20%. It costs you everything. What happened next took place almost entirely behind closed doors, over about 72 hours. On Wednesday and Thursday, Archegos could no longer meet the calls. The money was all in the positions. There was nothing left to post. So on Thursday evening, March 25th, something extraordinary happened. The banks held an emergency conference call with each other. Rivals who normally share nothing sat on one line and discovered, in real time, the thing that should have terrified them months earlier. They were all in. Every one of them had lent billions to the same invisible man, against the same handful of stocks. On the call, the idea of a truce was floated. Unwind the positions slowly, together, over weeks, so nobody triggers an avalanche. Everyone knew the alternative. If even one bank broke ranks and started dumping first, the stocks would crater, and the slowest banks would be left holding the wreckage. It was, in the purest form finance has ever produced, a prisoner's dilemma. Cooperate, and everyone loses a little. Defect first, and you escape while the others burn. Every banker on that call understood the game. Every banker on that call also understood that every other banker understood it too, which meant the truce was dead the moment it was proposed. They agreed to think it over. The call ended without a deal. Several of the people on it went straight back to their desks and began preparing sell orders for the morning. Friday morning, March 26th, before the market even opened, Goldman Sachs began the avalanche. Block trade after block trade, 6 billion, then more, hitting the market like controlled demolitions. Morgan Stanley was right behind them, unloading billions of its own. This was the mystery selling that opened this story. Not a strategy, but a stampede, the fastest banks saving themselves at the expense of the slow. By the close of trading, close to $20 billion in stock had been forced onto the market. Viacom CBS had lost roughly half its value in a week. And in New Jersey, the quiet man who started his mornings with scripture watched a fortune it had taken 25 years to build evaporate between one weekend and the next. Bloomberg's wealth trackers would later estimate the damage in a sentence that still reads like a typo. Roughly $20 billion of personal wealth, gone in about 2 days. 20 billion. 10 billion. 0. In 48 hours. And through all of it, this is the detail people find hardest to believe. The man at the center said nothing. No press conference, no tweet, no interview. While traders traded rumors about the mystery whale whose corpse was washing up across the market, Archegos released exactly one statement, through a spokeswoman, calling it a challenging time for the firm. That was it. A $20 billion fortune, one of the largest in the world, exited history with a single sentence of corporate boilerplate. Wall Street veterans reached for comparisons and found only one: the collapse of long-term capital management in 1998. The hedge fund failure so dangerous the Federal Reserve had to organize the rescue. Except this time it wasn't a fund run by Nobel Prize winners. It was one man, his family's money, and 8 banks that never thought to ask each other a single question. But a collapse this size doesn't stop at its owner. And this is where the story leaves New Jersey and goes global. The fast banks escaped almost untouched. The slow ones were massacred. On Monday morning, Japan's Nomura warned investors it faced a potential loss of about $2 billion. Then came the announcement that shook Europe. Credit Suisse, the 167-year-old pillar of Swiss banking, admitted it had lost $5.5 billion on a single client, more than the bank's entire profit from the previous year. Incinerated by one family office it barely monitored. Credit Suisse never truly recovered. Scandal piled onto scandal, clients fled, and 2 years later, in March 2023, the Swiss government stood by as the bank was sold off to its rival UBS in an emergency rescue. Bill Hwang did not cause the death of Credit Suisse on his own, but ask anyone in finance to name the wound that started the bleeding, and this is the one they point to. All the banks together lost more than $10 billion, on a client most of their own executives had never met. For a year, nothing happened to the man himself. Then, at dawn on April 27, 2022, federal agents arrested Bill Hwang at his home in New Jersey. He was not arrested alone. His chief financial officer, Patrick Halligan, was taken into custody the same morning, accused of helping to feed the banks a sanitized picture of the firm's books. Prosecutors charged Hwang with racketeering, securities fraud, and market manipulation. And their theory was simple. This had not merely been reckless betting. Archegos, they argued, had deliberately used its swaps and its size to pump the prices of its own stocks. A scheme that, in the words of the government, had threatened to ripple through the wider financial system. At trial in the summer of 2024, his own former lieutenants testified against him, describing how the firm concealed the true size of its positions from every bank it dealt with. His defense made an argument worth pausing on. If this was all a fraud, why did he never cash out? He took nothing off the table. He kept every chip in the machine until the machine exploded. Hardly, his lawyers argued, the behavior of a con man. The jury deliberated, and in July 2024 found him guilty on 10 of 11 counts. That November, a judge sentenced Bill Hwang, then 60 years old, to 18 years in federal prison, calling the scale of the damage almost without precedent. His lawyers are appealing. The judge also ordered him to help repay billions to the banks he wrecked, money that, for the most part, no longer exists. Before the verdict on the man, one more verdict on the story, because two myths have attached themselves to this case, and both deserve a straight answer. The first, was this really the biggest personal loss in history? As far as anyone can measure, yes. Fortunes have been lost before, but no individual in the modern record has lost this much, this fast. $20 billion in 2 days, with the whole fortune effectively at zero within the week. The second myth is more uncomfortable, that Bill Hwang was simply an unlucky gambler, punished for losing. It's the version of the story his defenders still tell, and the jury heard it too. But the conviction wasn't for losing money. It was for the machinery of concealment around the bets. For the fact that 8 banks lent tens of billions to one man because each of them was shown only a sliver of the truth. Losing is legal. Making yourself impossible to see is what turned a disaster into a crime. And that, in the end, is what separates this collapse from every flashy fraud story you've ever heard. There was no penthouse, no private jet, no stolen customer money. The fortune he destroyed was, on paper, his own. Bill Hwang built the most dangerous portfolio in America out of discipline, faith, and mathematics. And it died from the one thing it was designed for: invisibility. Regulators couldn't see it. The banks couldn't see each other. The market couldn't see who was moving it. A machine that big, running that hot, with nobody watching, the only thing it was ever going to produce, sooner or later, was the biggest loss in history. The most dangerous man in the market is not the one everybody is watching. It's the one nobody can see. Bill Hwang lost his own $20 billion, and the banks lost $10 billion more cleaning up after him. But at least his fortune, while it lasted, was real. There is another company, once worth more than Deutsche Bank, the pride of an entire country, whose money simply never existed. When the auditors finally opened the accounts in Manila, they found nothing. Almost $2 billion, imaginary, and the executive who built the illusion boarded a private jet, vanished, and is now believed to be hiding under the protection of Russian intelligence. That story is next.